Our first guest this evening is the man who sent those tweets. Chief economist and global strategist, also the founder of Schiff Gold and the owner of Europac Gold. Let's welcome Peter Schiff back to the program to get some answers. Peter, welcome back. So we saw this go down late Friday. We stuck it into our Friday show, and a lot of us behind the scenes were going, this is not going to end well. This is huge. When you start looking at the tech companies that kept their money there to the tunes of hundreds of millions, and then for Joe Biden to say, yeah, it's not going to cost the American taxpayer a penny, but then I'm not a banker, I'm not an economist like you, but I do know when I signed up for my first account as a kid in my teens, the FDIC only insures $250. So if Roku says, I want 100 million of my hundreds of millions out of that bank today, can they get their 100 million? And if so, who's paying for it?
Yeah, well, first of all, it absolutely is a bailout. And even if the stockholders of these two banks are not getting bailed out, their wealthy customers are. You're talking about very sophisticated, high net worth individuals, corporations that had unsecured deposits. They should be losing, but they're not going to lose because they've been bailed out by the government. You know, what we are experiencing now, this is the beginning of the 2023 financial crisis, which is going to be a lot worse than the one we had in 2008. In fact, it was the government's 0% interest rate policy and quantitative easing that sowed the seeds for this crisis. Of course, they created the 2008 crisis, and this one is even bigger, but I think they're acting quicker this time around. In the 2008 financial crisis, they raised the limit on insurers' deposits from 100,000 to 250 because it was 100,000 before 2008. Now it's basically unlimited. They're going to guarantee all the deposits, and this is a massive bailout for all the banks that haven't failed yet, but which were going to fail during the week and next week if the Federal Reserve didn't step up and backstop all these companies, or all these banks rather, by agreeing to take on all their underwater paper. All these banks are loaded up with long-term treasuries and mortgage-backed securities that are worth considerably less than they paid. They're now able to take that paper and give it to the Fed for 100 cents on the dollar, and that is a massive bailout. It is a return to quantitative easing, and the way Americans are going to pay for this is through higher prices. Inflation is now going to go through the roof. If you thought it was bad last year, wait till you see how much worse it is in 2023 and 2024. Wow.
Not the news I want to start a Monday off with, Peter. Thanks a lot.
Don't shoot the messenger.
I know. There's other people that need to be shot. But anyway, that's a joke, folks. That's a joke. If Jane Fonda can joke about murdering politicians, I can joke about shooting bankers, right? It's a joke. It's a joke. Peter, talk to me about the long-term effects this is going to have on the market, because all the analysts on Friday were saying, we're going to see the market crash now within 60 days or less. That seems pretty crazy to me, but is it that crazy of a notion?
Well, look, if the Fed did the right thing, the market would crash. But the Fed's not going to do the right thing. It has no history of doing the right thing. It is doing the wrong thing. In fact, the reason the markets like the news, apart from the fact that nobody's losing any money apparently, is that the rate hikes are probably off. The Fed is going to stop fighting inflation. The Fed is going to actually go back to creating more inflation. We're going to get a resumption of quantitative easing. In fact, quantitative easing resumed today because that's the process that the Federal Reserve is able to bail out all these banks, is by printing money and taking their mortgage-backed securities and their treasuries onto its balance sheet. So the Fed's balance sheet is now going to expand and more money is going to be created. And so we're going to have a lot of inflation. And inflation is good for stock prices, right? It makes prices go up. So the price goes up at the supermarket, but it also goes up at the stock market. But the problem is, I think the prices in the supermarket are going to go up a lot faster than the prices in the stock market. So you may see your stock portfolio go up, but it's not going to go up as fast as your grocery bill or your electric bill or your insurance bills or any
Peter,
of the other prices you pay.
For most Americans who don't have a stock portfolio, they could care less of what you're talking about. They're going to be totally you-know-what when they see what happens to the prices that they'll be paying in 2023. Yeah, that's the key here.
Yeah, absolutely. I mean, the people who had money on deposit at this bank, they're the ones that should have lost. But because they got bailed out, everybody is going to lose. And when Biden says your bank accounts are safe, they're at greater risk now than ever before. See, the real threat to your bank account is no longer that the bank fails. The threat is that the value of the money is destroyed through inflation. Every bank account is going to see a significant decline in its purchasing power. What I would do if I had a bank account, I had any savings there, I'd take the money out because it's going to lose value. Buy gold, buy something real. But the riskiest thing you could do right now is leave your money in the bank because you're guaranteed to lose.
Wow. All right, that's a powerful statement. You and I may talk offline. I may need some advice on what to do with my money, Peter. Final question to you, real easy, because Joe came out doing what Joe usually does. Put the tweet up, please. He took no responsibility for anything in his inactions, because I know it wasn't any of his policy that set banks up this way. But I'll go back to 2008 when we saw those mortgage-backed securities fail and everything went to hell. We know what happened. I lost my shorts. So when he puts out this and says that the previous administration lays it all on Trump, it's his administration is at fault for the banks collapsing like this, is there any validity to that?
Well, not really. And in fact, look at his own Secretary of the Treasury, Janet Yellen. I mean, she did a lot more to engender this collapse than anything that happened while Trump was in office. But I'm not going to completely absolve Donald Trump for the deficits spending that occurred under his watch. He was helping to create the deficits that the Federal Reserve was monetizing. But the real roots of the problem go back to the Greenspan era and the low interest rate policy that followed the bursting of the NASDAQ bubble in 2001. That was the Fed's major mistake. That's what inflated the real estate bubble. And then they doubled down on those mistakes when that bubble popped and they went to zero and they went to quantitative easing. And then they tripled down during COVID when they just went to QE4 and just printed money like crazy. And we're now experiencing the consequences. You know, the Fed made a deal with the devil back in 2001 when QE started, and it took 20 years, but the devil is now here to collect.
Wow. All right. So check your portfolio, folks. If you got anything, make sure you know where you're investing. Look at something solid, I guess, like gold, because, you know, I thought we got this fixed in '08, but obviously we didn't. We just robbed Peter to pay Paul, and we pushed it down the road, and here we are down the road. And as Peter just told you, the devil's coming calling. Thank you, Peter, for your expertise and insight, as always. Even though it's not good news to hear, we needed to hear it. Thank you.
Take care.
Yep.